Everybody who made money started early in crypto. I mean, they went up and down, went from $1 to $5 million to 10 cents to $300 million and down again. So the key to success is being early, getting on the train.
I was originally in the advertising technology sector, and then more recently and more relevantly for BlockFi, worked at two different companies in the fintech sector, specifically the lending side of fintech. And while I was working at one of those companies, I started a small blog that was talking about different types of new fintech companies that are creating products for consumers like robo-advisors and lending platforms. And that's what led me to discover Bitcoin.
But I think one of the more interesting words you use today is fintech. And the reason fintech is important, in my opinion, is because fintech is going to put bankers out of business. So just as there's pilots who are unemployed today, fintech is going to make a lot of bankers unemployed also.
It's a trend that's been in place for a while now. Throughout my career, I've hired a number of folks from traditional banks and traditional financial services firms, and they always have a similar reaction when they come and work at a financial technology company, and it usually centers around two things. Number one is they're like, oh my God, I can't believe how fast we're moving. Because fintech companies, you're constantly innovating, you're constantly building new products that add more value for your clients. And banks, everything moves at the speed of a slug. What you could do with BlockFi is you could, either using our website or our mobile app, create an account. You could connect to your bank account and ACH dollars onto our platform. The minute that those dollars hit our platform, you're earning an 8.6% annual yield on them that's paid out every month. We turn it into what's called a stablecoin, which is basically a digital representation that's backed by $1 in a bank account, but it's a dollar token. And that's what you're earning 8.6% interest on. Now, at any point along the way, you can take the $100 out of stablecoin and send it right back to your bank account, including with whatever interest that you've earned. Then you can also use those dollars to buy either Bitcoin or a tokenized version of gold, which is also available on our platform. Once you purchase those things, you start earning interest in that asset. So right now, if you're holding Bitcoin on our platform, you earn a 6% annual yield on your Bitcoin paid in Bitcoin.
I just want to know, how in the world can you promise 8% interest?
We operate in the cryptocurrency sector, which today fundamentally is a nascent asset class with some structural inefficiencies still, and a lack of access to scalable traditional pools of capital. So what that translates into is two things. Number one, there are lots of opportunities for trading firms who are doing market neutral arbitrage type strategies to make money. And number two, because there's not a lot of capital available, when you're making loans that are even loans that aren't risky at all, because you're lending someone 50 cents and they're giving you $1 of collateral, you can still earn a pretty high yield. It's still very common today that, the price of Bitcoin will be 20 different things on 20 different platforms. So if you're buying Bitcoin on Coinbase and someone else is buying Bitcoin on a platform in China, they might pay a price that is $100 different. And that's just a market inefficiency that some people take advantage of. It's still very early days for the asset class overall. I think that Bitcoin is going to take market share from gold over time. I think younger folks are much more attracted to Bitcoin than they are to gold. And so, over time, you'll see that reflected in the investment market caps of each asset. I think that you're going to see some incredible innovation in terms of global access to financial services. We're very, for all the things that we could say are wrong with the US system, we're very fortunate to not be in a worse system, of which there are plenty worse financial systems and regulatory regimes than what we have in the US. And I think that blockchain payment rails and what's happening in the cryptocurrency sector, similar to the internet, is tearing down a lot of walls that existed before in terms of accessing financial products, financial services, and different forms of money, which matters not that much to folks in the US. We already have a lot of good stuff and every product that you could ever want. So we're like, just holding on to gold in our own custody. But to someone in other countries where they might have hyperinflation or corrupt regimes, this can be very powerful.